Welcome to Chapter 12. Here we shift direction a little bit, and what we're going to be looking at here is the third financial statement that is commonly used. We're all aware of the income statement and the balance sheet. However, not much attention is paid to the statement of cash flows, which is the third financial statement required under U.S. generally accepted accounting principles. The purpose of the cash flow statement is going to answer several questions. For example, where does a company get its cash? Where does it spend its cash? Why did the cash balance change? And moving to the next slide, slide 7, we say, okay, how did a company fund its operations? Does it have, or did it have, enough cash on hand to pay its debts? Did they make dividend payments? Did they have to borrow funds? Did they sell stock? Well, these are the questions that a statement of cash flows will answer for you that the income statement nor the balance sheet will do for you. Before we do that, though, we need to make sure we are all on the same page as to what is the definition of cash flow. By cash, or cash items, by cash we mean currency and cash equivalents, meaning anything that is either cash or is readily convertible to cash in the short term. So with that, let's move to slide 9, because in slide 9 we are going to talk about the statement of cash flows having three major sections. The first is the operating activities, which concentrate on the firm's operations. In other words, it's day-to-day business. Was it cash flow positive or cash flow negative? Obviously, this is going to be the most important part of the statement, because this is going to let you know whether the business is a standalone business or is it going to require outside financing. The second section is the investing activities, and here we're looking at what did the company do with cash. Did they invest or did they divest? Did they sell off assets? The third section is the financing section, and here we look at whether the company borrowed money or sold stock or paid dividends. So let's take a look at section slide 10, which deals with the operating activities. And in that section, you'll notice here we're looking at receipts from customers, net income. We're looking at outflows, increases or decreases in current assets. In the next slide, slide 11, we look at the investing activities, and here we're concentrating on, did we buy or sell long-term assets? Did we buy or sell equity investments in other companies, etc. Slide 12, we look at the financing activities, and here we're dealing with, did we sell stock or did we borrow long-term money, or did we pay back loans, or did we pay dividends? And then finally, we also need to keep aware of, there are some non-cash items on slide 13 that deal with non-cash transactions. These are not recorded on the statement of cash flows. Rather, these are all reported under the footnotes to the financial statements. And then let's look at slide 14 that will give us the statement format. And again, it's very straightforward. We list the cash flow from operations, investments, and financing. We add those up and we get our increase or decrease in cash, and then we show here's where the cash was at the beginning of the period, here's where it is at the end of the period, and the explanation then having been the net increase or decrease. Now, there are two methods that we can use to calculate the statement of cash flows. The one that is used by more than 97% of all companies is the indirect method. That's what I will concentrate my comments on. The other thing you do need to know is that in the U.S., the indirect method is the only one accepted under generally accepted accounting principles, or our friend GAAP. So in the indirect method, notice we start off with net income. We look at any gains or losses. We look at changes in current assets. We look at non-cash expenses like depreciation and amortization, and then we get our cash flow from operating activities. So if we move to the next slide, slide 18, we have a table again. This is one of those tables, those special tables that I recommend that you keep at your side. You'll find this very helpful. And what it reads is that if we had a change in current assets from the beginning to the end of the year, if our current assets increased, we subtract those from net income. If our current assets decreased, we add those to net income, and just the opposite for current liabilities. Now, one word of comment on the current assets. Most people might think if my current assets increased, that was good. Well, from a cash flow standpoint, it isn't good because that uses up cash. So we have more cash now tied up in accounts receivable or in inventory. Therefore, that is using up cash. That's why if we have an increase in current assets, we subtract that from net income. So if we move to slides 19 through 24, here there's an example in the book. We're just going to, or in the PowerPoints accompanying the book, we're going to move through those pretty quickly. We have a company that reports $125,000 net income. Accounts receivable were up, accounts payable were up, and the company reports depreciation expense. We want to know what its operating cash flow is, so we'll quickly scroll through these. Slide 20, you'll notice we start with the net income. Then in slide 21, we add back our depreciation because it's a non-cash item. And notice we do depreciation, depletion, and amortization. Let me explain the three of those. Depreciation deals with fixed assets. Depletion deals with natural resources. Amortization deals with intangible assets like patents, trademarks, copyrights, franchises, all of that. They all mean the same thing. They are the periodic write-off of a long-term asset. Okay, so moving on then, you'll notice accounts receivable went up, so we subtract that from net income. And then finally, accounts payable went up. We add those to net income, and the reason for that is that if accounts payable went up, that means that we're using not our cash, we're using our supplier's cash. Then finally, this would tell us that using the indirect method, cash provided by operating activities was $140,000. So we would also do the same for the investing section and for the financing section to calculate our full statement of cash flows. Those two sections I'm not going to cover here in the comments because they're covered in the other PowerPoints. What I want to do is move to slide 34 and then look at one final measure that we have available to us, and that is cash flow on total assets, which is we take our operating cash flows, we divide that by our average total assets, and that lets us know how much operating cash flow was produced by our assets as a measure of efficiency of usage in our assets.